So the catalyst, so we're looking at McDonald's. The catalyst for this company is the earnings, which is scheduled to be November 9th this month, so November 9th. And I think that this company is going to suffer another dip, which could present a very good buying opportunity. And so in the past, it has been really missing. The past couple of quarters, it has been missing on the earnings per share. The revenue's been really good, but the earnings not as well as a lot of analysts and people are thinking. So this company has historically performed pretty well. So even if you buy it now, you should do pretty good in the long term. Plus, it has that dividend yield of 2.5%. In the past 5 days, it has suffered dips around 6% to today and 7% around the lowest. So this company has already suffered a dip, and I have reason to believe that they're not going to be, and the company can suffer maybe 1%, another 1 or 2% dip, and so we should get a little bit of what is it called, a margin of safety. So 10%. If we're going to be like 10% from where it was originally trading at, which is going to give us a little bit, it's going to give us a little cushion if we're investing in the long term, maybe get 10% better gains than what we would have gotten. And so I think that is really good. So the earnings per share, you can see what it looks like. So you can see how it looks. And so really they haven't beat at all. And the only time it really did beat, it was less than 1% of a surprise. So I have reason to believe nothing's going to be different. Now we can see kind of how it looks month over month as far as the recommendation trends and the recommendation rating, 2 out of 2, a buy. Also, we can see what the analyst price target to believe it to be at, which the average is higher than the current price. So we should see an upside after this dip, or after the dip it has already suffered. But the lowest price analysts have is $185. So the analysts have been kind of either too bullish on this company for this company to be missing that much on the earnings, or just the company hasn't been able to perform as good as it should. So that average, you just do give or take. As well as nothing in this video is financial advice. Don't take it that way. So in conclusion, I believe that this company will take a dip after earnings, maybe 1 or 2% more, which will give us a 10% cushion or margin of safety. So I think that is going to do really good, and that's going to give us a good margin of safety to be invested into this company. So we're going to have that dividend yield, and we're going to have that long-term gains. I think this is a safe play in case of a stock market crash, or if Trump or Biden wins and all this election fears and things like that. So I think this is a really good potential buy. So now we're going to go to the next company. The next company is Upwork. Upwork is a really good company. I've done a full stock review on this company multiple times. Now, the only problem with this company is that the people who work for this company, who are the freelancers and things, don't like it. But before you dislike this video, watch my full video on that if you want to see all the pros and cons of this company. But anyways, I think still long-term you're going with this company. This company has been down a good bit from its highs when it just didn't really go up for any reason. It was not really news. It's just that this company is a really good company, and I think people are realizing that. But now it's down around 8%, 9%. So I think it could be down today. You never know. But the earnings are supposed to be coming up November 4th of this month. So November 4th, I believe that's in 3 days. And so I don't believe that the election will get to this. So we can also see the past history for this company, the previous quarters. And so they usually beat it by a lot, or you miss the earnings per share by a lot. And it only has happened one time, which is quarter one of 2020, when there was a lot of fear in the market. And now there's a lot of fear in the market for this past month. So maybe it will miss, or maybe it's either going to miss massively or beat massively. And so if you are a swing trader or a short-term investor, you're looking for short-term gains, I think this is one of the best on the list, because long-term, you're golden. Even if it drops maybe 8% because of something that happens, long-term, you're golden. And in the short term, you're going to do really amazing if they are going to beat the earnings per share, because they're probably going to either beat it by a lot or miss it by a lot. And so yeah, that's what I think about this company. So Upwork is a freelancer company. It's kind of like Fiverr, but I'm not going to give a full stock review on this company. Make sure to subscribe if you want a stock review on this company soon. Anyways, so the earnings history, you can see what it looks like. So yeah, and now we're going to look at the recommendation trends month over month. And so we see that most people who are invested in this company are bullish on this company. It's at a buy to buy, and the average price target is higher than the current price. And so I think maybe this company will do good in the short term. I'm just speculating on that, but long term on this company, I think you're golden. So now we're going to go to the next company. So the next company we're looking at is Apple, not because of earnings or things like that, because we have a pretty good margin of safety of around 16% from its all-time highs. We've done a pretty good dip for a great company like this, and it has recently overreacted to news, in my opinion. And this company, people who are invested in this company are not dividend investors. They're most likely not growth investors, although there is some of them, and they're all of them are most likely not short-term investors. They're all really long-term investors. So the fact that this was news came out is what a short-term investor is going to look at. Not as much as a long-term investor. Yes, they're going to look at it, but it's no reason to sell a company for that just one thing. So I think that that was an overreaction, and it's just giving us a better margin of safety if we decide to invest in the company. So the dividend yield is less than 1%. We're not worried about that. But I also like to see that when it was down around 20%, the past time it was like that, the last time it was like that, well, the company went back up. And if you don't consider that the last time, well, then we can look right here. Anytime it's down that much more than 20% from its highs, it usually goes back up for at least the past year. Past 5 years, this company has gone up massively and then shoots down every now and then again. But as you can see, it's never really more than 20%. I mean, that one time was around 30%, but not really too much. And then after that, it just goes back up massively. So that's kind of why I'm looking at it now, because it's down more than 20%. The last time I made a video on this, it was around this price, and then it shot up to I think 113 or 115, something like that, and now it's back down again. And I think it's really a great time to buy. Same thing as last time. So now we're gonna go. Oh, and also another good reason to buy it is because even with all the fears of this election and things like that, this may suffer a little bit of volatility. So it may go down another 5% or something like that. I don't see it going down more than 30%. Also, it's gonna be less volatile than electric vehicle companies and a lot of other companies. So yeah, that was the second one. So now we're gonna go to the third one. So the next one is Facebook. I've done a full stock review on this company as I have done with Apple, but both of these companies are really good companies and have been really the recent news that has happened has been an overreaction. Now, Facebook, that news that came out could potentially be a problem, but I don't see the reason why it would go down a good bit as much as it has been, because Facebook has been suffered with problems like this, and they really get over it really soon because they have such good management. I really do believe in his management a lot, and when I watch videos and conference calls and a lot of different things from the CEO, well, he says the same thing. They suffer a lot of problems. I think on a video where he gave like advice to entrepreneurs, it was like that. He's like, you're gonna suffer a lot of problems. You just gotta like have the mentality and the work ethic, all those good things to get over it. And I think that the CEO has all the things to do that, as well as the management in general. And I feel like this is an overreaction, and I don't think that it's going to be a problem and else he can't solve it. And I have full faith in this management that they will solve it. And we already have this margin of safety because of the overreaction, in my opinion. And so maybe we will see a dip to 200 or maybe even 230. But I think long term, you're golden with this company. As you have seen, this company has done really good in the long term, especially this past year. So that was the third one. Now we're going to go to the fourth one. The next company is Winning Resorts, made popular from Germany for financial education. This company has a great dividend of around 5.5%, as well as the stock price is pretty undervalued compared to the past of this company, as well as where I think it's going. I think it's severely undervalued. So long term, same thing, you're golden. And I think that is actually, the earnings date is the 4th of November, but I actually think that it's going to miss. And so I think it's going to give us an even better cushion or margin of safety. I think we're going to get a pretty good upside from the day of its earnings after the earnings or so, because I think the earnings are going to do pretty bad, just like it has done in the past. You can see right here what it has looked like. So people investing in this company really don't know. Some of them are saying buy, some of them are saying hold. In the past month, it has been really just a hold. So people are just being too bearish on this company, or either too bearish or they're too bullish. I really don't know right now. I was expecting with this company. So if you're looking for short-term gains, I don't think this would be the company to do that. But I think that it may suffer a dip, because I really do believe that the earnings are going to do bad like it has in the previous times. And we're going to see a dip, and we're going to get an even better entry point. So that's what I have for Winning Resorts. Now we're going to go to the next company. The next company is Elf, which I think is one of the better ones on this list. So the last one is Elf on the Shelf, Elf Beauty Incorporation. This is one that I'm definitely thinking about buying myself. This company earnings date is going to be November 4th, like a lot of these other companies. Really, the best ones are on November 4th for some reason. But this company has beat revenue and earnings per share for the past at least 4 quarters, and it has done it by massive amounts. I think that this is going to be no different, but I think that it may not be as good simply because it has done so good in the past quarters. I just have to say it, but I do think it's going to beat it, but maybe not as massively as it has done in the past. So I don't expect 300% earnings per share, how much it can beat, but I'd maybe expect 50%, 70%, something massive around there. And I do expect the stock price to maybe give a 5% jump, something like that. So in summary, Elf and Upwork are the best ones on this list for short-term gains. As well as we're going to look at the Elf earnings history. It has done really amazing, as you can see. And so we're going to look at the investment sentiment. So it has been more of a hold for this past month, but in the past couple of months, same thing, strong buy, and a couple people saying that it's in hold. So it's a 2.1. It's between closer to a buy, but between a hold and a buy. And so the average price target is $24, while the current price is $20.27. And that gives you a pretty good upside around 20%. So I think that's really good, and I really do expect it to beat revenue and earnings. And in the long term for this company, you're definitely going. I think Upwork and Elf are the best ones to swing if that's what you're looking for. So if you're looking for to make some money this month because maybe you won't do it with your other long-term investments, I think Upwork and Elf on the Shelf are going to be some of the best companies to do that. So these are stocks to watch for in November. Remember, nothing in my videos is financial advice, and I'm not a financial advisor. It's simply just for entertainment purposes only. But make sure to subscribe if you haven't already. And if you found anything useful in this video, definitely subscribe. Thank you for watching, and goodbye.